Good morning, ladies and gentlemen. By my calculations, the risk dial is still slightly positive, around plus 10, plus 20. The good news is that we are working on it now, and hopefully next month it will be up to date completely. This week we have Jackson Hole on the Thursday and Friday. It will be interesting to see if the Fed does push back against anything that the market has priced. This week I want to explain to you what is happening in the market, what is being repriced and what isn't, and what the Fed, I think, could push back against. So without further ado, let's have a look at what the bond market is telling us. Before we have a look at the yield curve and the individual tenures, it's interesting to have a look at what the money markets are pricing. So these are the euro dollars all the way out to 25, and this is EDU22, the one that I'm long of. And basically that is stuck around this 96.67. It's just below what it would be pricing, around 96.75 if the Fed hiked by 50 basis points in September when it expires 2 days after the Fed meeting. What is interesting to see is what is happening on a weekly basis. So EDU 22 closed last week at, the week before at 96.63, and it closed this week at 96.67. So it improved by 3 basis points. And as I keep on telling you, it's going to go up to here at about 75 if the Fed hikes by 50 basis points. That is where I think it will expire. Now, if we have a look at something like EDZ23 and we enlarge this chart, you can see how it's completely different. Last week, the week before, it closed at 96.58, and this week it closed at 96.48. So that went down 10 basis points, and EDU22 went up 3 basis points. If we have a look then at, say, EDU24 and enlarge this weekly chart, you will see much the same. It went from 97.07 to 96.87, so that's 20 basis points. So what is happening in the money markets? They're taking out the expectations of any kind of a turn, i.e. cutting by the Fed anytime in 2023, and pushing that back in 2024 and 2025. Those are giving up ground as well because the way the forward works, but also because the cuts that are implied are going to be less. So it's higher for longer. The terminal rate is not necessarily moving. The terminal rate is still around the 3.5 area, right? So, but it's higher for longer. And that is precisely what the Fed has been saying, that once they have reached a restrictive policy, and let's call that 3.5% for the sake of argument, because we still don't know what it will be ultimately be, but it's likely to be a restrictive one. So if 2.5% is neutral, what is restrictive? Well, let's call it 3.5, and let's see where the chips fall when the data actually comes in. But whatever the data is, it's going to take many, many months for the Fed to decide that then it's time to cut, as opposed to just hold rates where they are. And that is why the position that we have is the ideal position: long EDU22, short EDZ23. Can it go much more? It can go another 20 basis points easily, simply because this is likely to rise, and EDZ23 is likely to do not very much at all. So now that you understand what is being priced by the money markets, it'll be easier to understand what is being priced in by the bond market. This is the Treasury futures yield curve. In red, you have the prices of last week, and in blue, you have the prices of this week. As you can see, the curve is actually pivoting around the 2-year area. The 2-year is doing absolutely nothing, and it's the 3s, 5s, and 10s which will be going up. Why should that be? Well, because you are going to run out of time in the 3s and the 5s, and to some extent in the 10s, because if the Fed is going to go to 3.5% restrictive and hold there for at least a year, then the 2s and 3s run out of time, the 5s mostly run out of time. You would be expecting for the 5s to move down, you would be expecting large moves by the Fed, easing moves at some stage after they've held the neutral policy around 3.5. So to me, the area between 3s and 10s has to go up some more relative to where the T-bonds and the 30s are. As a result, the 2s, 10s are likely to go back up slightly ahead of the Fed around around -10 area, i.e. disinvert slightly. That makes sense to me, because if the curve is shifting, is basic pivoting rather around the 2s, and the 2s are doing not a lot, then it's likely to be the 10s that suffer and go towards this -15, -10 area. So what are the other parts of the yield curve doing? Well, it's interesting to note that the 5s, 10s are doing not a lot, right? Weekly chart closed completely unchanged, but it still looks like it wants to push higher. And if we look at the 5s, 30s, this also to me looks like at some stage it's going to break through this very important level at around 11 basis points and push higher. I think the likelihood is still for higher 2s, 3s, 5s around that 3.5 area. And if we look at 10s, 30s, we are still likely to get to that -13, -14. So I think the curve is pivoting around the 2s. So 3s, 5s, 10s to me are in trouble. 30s much less so, but let's have a look at the individual tenures too. In the early part of the week, and these are the 5s, I don't expect very much to happen, simply because I don't think the market wants to go into Jackson Hole at very high levels, very close to the Bollinger Bands. But what is undeniable is that on a weekly basis, we've bust through resistance and we closed above 308. I think in the first 3 days we shall go sideways between 299 and 325, something like that. And then if the Fed is hawkish, and there's a very good chance that they will be, we could easily go and fill all these gaps around 338, or even trade up to this very important 359 area, which I have marked in red. Anything above there and we're in real trouble. So basically 2s are already basically at where the neutral rate is. 3s and 5s are going there, and 10s will try to get up there as well. I would have thought at some stage 10s will trade 323, 324, right around here, fill all these gaps, and then we will be ready to go down. But it depends on what the Fed says. In the first few days, I would expect just, not much change, and eventually to go back up towards 324. beyond 324, and everything starts being in real trouble, and it will affect equities quite a bit. 30s, I think, are much, much more sedate. I don't think that they need to particularly go above 345. To me, 345 is such a line in the sand, because if we go through 345, we're almost bound to get to 393, and that will really, really weigh on equities. So what I'm saying is, let's see what the Fed says. But if the Fed is very hawkish and it says that it needs to, that real rates need to be very positive for a longer period of time, even 30s won't like it. Certainly 3s, 5s, and 10s are going to be in trouble. But and I think more in trouble than 30s, because the 30s should really like the fact that the Fed is going to be very hawkish. But if even they go through this very important 345 area, then every asset is going to get hit hard. But I don't want to, panic. I don't think 30s should be particularly in trouble. Let's see what the Fed says first and then decide. What is happening in Europe? Well, nothing good. As I've been saying for a long time, down here, what is your risk reward in holding twos, shats? I mean, awful. Now, if it starts getting towards one, the risk reward actually is to be completely out of everything. I have very, very small positions still short of the shats, some leftovers. It's not going to go anywhere very far from here ahead of the ECB. The bobble, really, if it reaches this kind of area around the 120 area, there's not much risk reward there either. But it's, how can I put this? The risk reward is never to be long of this stuff now. The European economy is one thing, but the European inflation is much, much higher, or will be much, much higher than the US is. And I really don't see very much value in arguing the fact that European rates need to be lower. It just doesn't seem right to me, with inflation in double digits, that we should be buying 5-year stuff below 1%. To me, that doesn't make much sense. And the Bund, well, there is definitely some resistance here around 135, and I think ahead of the Jackson Hole, and also ahead of the ECB in the early part of September. Being neutral there is probably not a bad idea. But, if the US goes, this will go too, and it will probably not hold 169. It'll probably go quite a bit further. If we go on a monthly chart and have a look at what that looks like, could we easily get to 2? I mean, these levels up here, well, why not? It's so far behind the US. I hate European rates. I cannot get long of them but for a 50-tick trade. So I really don't see the point of arguing that European rates need to be lower. France, which is technically tends to be the best chart, it's got some resistance here at 190 odd. And if you see 2, I would be out of everything ahead of Jackson Hole. But if you look at a monthly chart of that, what do you see? You see that basically 245 is so important, and if it goes through 245, I mean, is 330 out of the question? It's that kind of environment. being long of this stuff in terms of futures is a mug's game. You could make 50, you could lose 1,000. So I really don't see that Europe is the place that you want to park any kind of money in terms of buying yields. This differential chart between the 10-year in Germany and the 10-year in the US is actually gathering definition, and you can see how this 181, 174 area is so important. You know, I keep on saying this and I keep on thinking this differential at some stage has to collapse and has to go to 125, 100, or even lower. Inflation is going to be a much greater problem in Europe than in the US. And really, if you have a recession in Europe and not so much of a recession in the US, well, that makes the funding problems in Europe even worse, and it makes the euro unattractive. And the only way to make the euro attractive is actually to hike rates, because at the moment policy is becoming looser and looser in Europe via the exchange rate, and to me that is unsustainable. At some stage the ECB has to do something about it. Will they, won't they? I don't know. But if they won't, then inflation is just going to rip in the EU, and it's going to be far more contained in the US. So why would you prefer to buy bunds at 1 rather than 10-year notes at 3? It to me it just doesn't make much sense. So Europe is, to me, a do not get long, just look for levels to get short of futures. Well, the dollar is just sucking oxygen out of the room. I did not expect the dollar to be this strong this week. I expected interest rate differentials between the euro and the US to come in, and I thought that that would support the euro for a few more weeks until the ECB. Nope, the bearishness for the euro is just off the charts, and it's justified insofar as their economy is in real trouble. And that is basically going to suck all the oxygen out of the room. If you look at the weekly chart, there is really nothing until this 111 area, 111.30, and then 118, which I don't, discount at all. So there's really no hope for the euro, it seems, at the moment. If we look at euro USD, it's a trend. It's a strong trend. It trades with the moving averages beautifully. Holds here for a few. Can you imagine what's going to happen if the Fed is bearish or the Fed is hawkish? It's just going to continue and continue and continue. And I don't think, it seems that interest rate differentials don't really count. It's not what's driving the market. The market is being driven by a differential in how the economies are going to perform going forward. And basically it's discounting that the winter is going to be very, very bad. Until we see a proper sign of reversal from the euro, being long of it, to me, is just money down the drain. Gold is another one of those do not own trade. If the dollar is going to keep on being strong against the euro, and if bonds are repricing to a neutral, not from neutral to a, we are going to stay at 350 for a long time, like I showed you, especially in the euro dollars, then gold is really not that attractive. Bonds are against it, i.e. real yields are against it, and the dollar is against it. And therefore it keeps on trading in a technical bear market. It tops out exactly where it should. 1830 has got the 1764 pivot, and then the only question is does it have a real mare and stop everyone out underneath 1710? More likely than not. Okay, I think it's more likely than not at 1764. If volatility is low, you buy puts and you see what happens. To me, the odds of owning gold the reasons for owning gold are just not there at the moment. DBC is basically caught at the moment between 24.39 and 26.93. I can't see it coming out of this range for a bit. I've seen what the CL yield curve is doing, and that is it's flattening, which basically means CL is not really under pressure in the back months, and therefore I don't see that that oil prices are going to collapse. Could they come down to $80? Yes, but they're not going to stay there for long. So I can't get bearish of DBC unless it breaks decisively below 24.39, and that to me will be a signal of demand destruction, and it will be a positive for the longer end of bonds for sure. So let's see what happens. I'm watching it. I'm very non-committal. I don't particularly want to be long of it, but shorting these levels, unless it breaks 24.39, not very appealing. The risk charts have not really changed that much over the past couple of weeks. You will see a little dip back in the equal weight consumer discretionary against staples, i.e. a little bit of risk off, but you see absolutely no risk off in SPY TLT. It's basically at the highest level it's been ever, and therefore it's basically saying that equities are favored over TLT. Could we have a couple of days of sideways? Yes, but that to me more indicates that if TLT, and as I showed you earlier in the chart of the 30s and what I think is going to happen to the bonds, that it's going to go a little bit worse in yield but not all that much. That would indicate that all proper dips in SPY are going to get bought. So basically, that comes down to here with a proper dip in SPY that we'll have a look in a moment, and it's going to get bought. So unless the Fed starts saying something really extraordinary, I expect the bearishness to be much more pronounced in bonds than in the equities. On the Blue Angels, it's just going to play around here for a while, I think. Depends, of course, what the Fed says. But with this chart, what I'm trying to say to you is that it's very unlikely to me that we are in anything but a period like this. That the pullbacks are not going to be enormous unless we start breaking in the 30s above the that 340 something. Let me have a look on the other chart. Yeah, the 345, 346 area. If we start breaking through 345, 346 area in the 30s, that is going to hit equities quite hard. As long as the, and why should that be? Because as long as the yield curve pivots around the twos, as I showed you, and the areas, the tenures that are hit are the threes, fives, tens, and not so much the 30s. The equities shan't mind that much. The equities mind very much what 30s do, not so much what threes or fives do. And therefore, it's important that we remain below 345 in the 30s. If we remain below 345 in the 30s and just, trade around, I don't think we're going to go back to a 16 multiplier. And that would be a real dip. I think we'll probably go to a 17 multiplier out of fear, and then basically stop there. And we can have a look at what kind of retracements are possible. So what I'm trying to express to you is that unless the 30s really start getting bared up, we are unlikely to go much below 4,000 or 39.43 for the time being. Why? Because I don't think earnings expectations are going to dip that much unless the Fed does or wants to really kill the economy. The earning expectations are coming down, and they're being rewritten and reappraised, and now it's really a question of of what multiple we're at. If 30s basically are going to be 3%, what do you want to do for a prolonged period of time? Then, times 16 is probably too cheap, and times 18 is probably just about right, but a bit expensive, and times 17 is where the dip gets bought. And where will that be? So to me, if the Fed basically doesn't say anything too bearish, and all we do is we dip to this red line around 41.40 in the S&Ps, that will indicate relative stability to me, and that any dip below that for gap fill purposes and so on is more likely than not to be bought. So I wouldn't get really bared up here. And if we look at a 195-minute chart, well, on Friday we finally broke 42.32, and it's indicating that we should be slightly short. But I think it stops around this 41.29 area, if not 41.79. Fills this gap down to here, 41.79, and basically we wait for the Fed somewhere around 41.80. That to me seems to be more logical than not. Now NDX with a high duration had a worse week. I never saw 13,816, but it tagged 13,717 beautifully, and I did sell a couple of lots there. What is likely to happen as the bonds do slightly worse? We are likely to basically tag 12,783 and stop there, I think, and basically just trade around waiting to see what the Fed says. What is interesting to me is the NDX over INX. We've had this rally off, and now we are basically coming back because we couldn't, this is a dead cat bounce. What is really going to be interesting is if we break 303, and just then it could be a very, very nasty fall. Two levels last seen, at the beginning of the pandemic, around here, 280, 283. This is still the very long-term trend saying that NDX outperforms INX, which makes sense, right? But we are right on the top of this trend, and we have a lot of room underneath. If that breaks, and I would expect that to break only if the bonds break, then we are looking at a big move, and that ties in with what I said for the 30s. If the 30s break that 33.45, they're going to go another 50 basis points, and this will break. So that's going to be interesting to watch. My clean chart, and I can enlarge it here for you. I will do this and that. Basically says that if next week, you should be slightly bearish now. It's broken a 1, 2, 3, 4-day low. If you see 41.26 before the Fed, or even after the Fed, if the Fed has Jackson Hole doesn't say anything really stupid, and of course I'll tweet to you my thoughts, it's probably a bounce area. It's probably an area where you will catch a lot of people short or getting short, and then the market rebounds. So 41.26 on my clean chart is really a very important area, and you can see how important a whole load of lows there which never got broken for quite some bounces. So risk reward says 41.26 is the area where you don't want to be short. I am pretty amazed by how contained volatility is and how well behaved. Could we get bounces up to 25? Absolutely. More likely than not that we will see them. But if it all stops there, it basically ties in with what I've been saying about I doubt that bonds break the 340, whatever it was, 6. And therefore I doubt that we go below 41.29 in equities, and that's that. So, what would that say? That would say that basically the Fed is going to wag the finger at us, but really not give us any pain. One interesting chart that I wanted to bring to your attention, and this makes very little sense to me, is the JPM stock against KRE ETF. KRE is regional banks. Now, why we should have come down quite so much in the relative performance of JPM, which to me is the best bank in the world, full stop, against the US regionals, which are a pile of dog shit, is beyond me. But I just want you to be aware of this area, which seems to be very important to where the market keeps on coming back to, and also how far away we are from the 200-week moving average. And anything in here, especially around 166, I think is a very good long-term buy. You are looking for very decent bounces of this level back around towards 2, and from 160 to 2, 20%, it's worth having. The other chart that says we're going to have a little bit of risk off next week is BTC, and this one is the one my preferred way to trade it, which is BTC over MSTR. I really think that you can see how volatile this has been. We bought it last year around here, sold it right here at 150. It's gone from 150 to 6 to 70, i.e. halved, more than halved, for no reason whatsoever, because BTC is doing nothing. And MSTR really should suffer over the course of the next couple of weeks or few days, and certainly 85.90 is my immediate first objective, where to take some profit. But the interesting thing is this is BTC against gold. You can see, and I'll actually enlarge it, you can see how important this level was. This is all the excesses. This is, BTC is the new gold. yeah, okay, boom, and it still keeps on going. And if you are not positive on gold, like I am, you can't be positive on BTC. And we all know that BTC really trades on risk, so we're probably going to get a little bit of risk off. And that to me is absolute, is the nail in the coffin for MSTR, because MSTR is basically a sentiment on BTC. And I'm 101% sure that MSTR is going to have a bad couple of days, the first few days of next week. Europe is interesting insofar as the equities are trading not well, but relatively well compared to what the expectations for the economy are. I think we're likely to see these. This is on a daily chart, 36.45, and on a weekly chart, 36.24. So in that area between 24 and 45, you definitely want to pick some up for a bounce, and that actually ties in with that 41.70 to 20 area in the S&Ps. So that gives me some comfort to go and pick some up there. And the one that really is telling me that equities are not really in trouble is Nikkei, because if all it does now is if it goes back to 28,335 and stops there on support, and this is the weekly, and basically it's still, and it goes down to 28,180 and 8 support there, and it just meanders, that is just not bearish. It just says that equities can't go higher, but it doesn't say they're going to go much lower, if you get my drift. So these two charts, both Europe and Japan, and volatility, are saying that we are really not going to have a complete mare in the SPX. What we could have is a mare in NDX, which leads to a mare in SPX. But that will be caused by the bonds, and that will be quite clear. And of course, I'll tweet it to you. I've updated the levels. I think, this is going to be critical next week, depending on what our friends at the Fed say. As I said, I don't think that they're going to change their minds, that they're going to do two lots of 50s by year end, and maybe another 50 up sometime in 23. They might wag the finger. They might not like the fact that the equities have gone too far, but I don't think that they're going to smash them down. To me, that these levels are going to be very, very important. 41.79, 41.29. I'll be looking to do something there. And NDX is going to be even more important, of course, because it will lead the SPX, and we'll take our clues from it. All the levels are here, and I've put the link for the Jackson Hole seminar. It's going to be very interesting. You should read what they're talking about, and that's where a lot of the speeches will be posted. Thank you very much indeed. Have a great Sunday, and tweet you tomorrow.